I'm going to look at Ray Dalio's All Weather Portfolio, how it's constructed, how you can construct it for UK ETFs, and I'm going to look at its recent performance in terms of growth and drawdowns. So the Ray Dalio All Weather Portfolio looks at four scenarios. It looks at higher than expected economic growth, which is the top quadrant, lower than expected economic growth, higher than expected inflation, lower than expected inflation. And it sees the economy as going through these areas of a cycle, 4 seasons, hence the all-weather portfolio. So when growth is rising, it says you want to be in stocks or corporate bonds, which are closely linked to stocks because they're issued by companies, commodities, or gold. When growth is falling, there's a bit of a flight for quality, and treasury bonds and inflation-linked bonds can do well. Here, the expectation is that interest rates will be cut as a result of lower expectations of growth. But if interest rates are already very low, then there's less scope to cut interest rates, and it might be more that just money is pumped into the economy instead. So that's a potential area where this paradigm can kind of break down, and that maybe bonds won't perform as well as expected in times of falling economic growth. Also with gold is seen as a store of value. It's also historically been quite a speculative asset, but with things like Bitcoin or maybe things like lithium, there may be other assets where people want to actually speculate and where they can see more price appreciation than they historically saw in gold. So now I look at the annual returns for these different ETFs. These are the ETFs that will allow you to construct the portfolio. So we've got S&P 500. I could use a worldwide ETF instead, but I do actually know that the S&P 500 will beat an all-world ETF, and actually Ray Dalio more uses the US market. We've got a long-term gilt. It's important that these are sterling denominated because that reduces the risk. There's no currency risk. We've got more of a short-term gilt. We've got commodities, we've got physical gold. We can see the overall returns here. Unfortunately, 2018, all the ETFs apart from gold had negative returns. Here are the maximum drawdowns. Bonds do better than equities in terms of drawdowns. And then the dates of the drawdowns, this is where I'm just looking to see roughly how the correlations are working. If everything draws down on the same day, then the assets are highly correlated. If they draw down at different times, you can see gold here got a different date in 2020 for its maximum drawdown to other assets. So that's quite interesting to just look at what is actually correlated and what isn't. So then what I do is put it all into a table. These are the weightings that Ray Dalio uses for his all-weather portfolio. So 7.5% gold, 7.5% commodities, 40% long-term bonds, 15% short-term bonds, 30% equities, and that's how he gets more of a risk parity around what's going on. In terms of the portfolio results over the last 3 or so years, maximum drawdown 6.85%, overall return 26%. So the drawdown is very good, the returns less so. And then if you're all in equities, maximum drawdown 22.6%, but you've got 61% growth, and that's shown in the graph here. Quite a steady line for the all-weather portfolio, but it's lagging behind equities quite a lot. So the problem with the all-weather portfolio is that generally we live in a world where there are expectations of growth and where people do want to put money into companies. So because the all-weather portfolio has such a tilt towards bonds, that will hamper its overall returns. And it is slightly disappointing because Ray Dalio quotes some good longer term results for the all-weather portfolio, but unfortunately I do think that some of the linkages that he saw are kind of breaking down, and that's then leading to lower current returns in that all-weather portfolio. So the challenge now is to find other asset classes that aren't correlated and that can be combined to get a decent portfolio where the drawdowns aren't that high and the returns are good. So it could be things like private equity, maybe some infrastructure funds. So there may be other things that we could put into this portfolio that will generate some better returns. And one of the things that I do with my coaching clients is I help to build portfolios for them and then model the returns, and then I'll give them this spreadsheet so that they can play around with it and put together scenarios themselves to see what's going on. And if you're interested in that coaching, then you can message me via Twitter, Ian Shadrack, via LinkedIn, or you can contact me via eBay. So I hope you enjoyed the video. Please consider subscribing, like the video, and if you've got any comments, I'd be really interested.